Fair value gap is one of the most talked about concepts in trading. When used properly, it helps you spot areas where price is more likely to react, especially where markets moved too fast before. Today I'll show you how to use fair value gaps in a practical way and how to filter out the ones that matter from the ones that don't. A fair value gap forms when price moves too fast in one direction and doesn't trade efficiently. On the charts, this appears as a 3-candle pattern. The first candle starts the move, the second and the third candles continue the move. The fair value gap itself sits between the first and third candles where their wicks do not overlap. That empty space is created by the second candle's aggressive push. Now there are two types of fair value gaps. A bullish fair value gap forms when the high of the first candle is lower than the low of the third candle and is commonly found in bullish conditions or strong uptrends where buyers are clearly in control. In this chart, the trend is clearly bullish. If we zoom in, we can see a fair value gap formed by a 3-candle structure where the wick of the third candle does not overlap the high of the first candle. Price moves higher first, then later pulls back into this fair value gap before continuing upward. A bearish fair value gap forms when the low of the first candle is higher than the high of the third candle and is commonly found in bearish conditions or strong downtrends. In this chart, the trend is clearly bearish. If we zoom in, we can see a fair value gap formed by a 3-candle structure where the wick of the third candle does not overlap the low of the first candle. Price moves lower first, then later retraces back into this fair value gap before continuing downward. Now that you understand what a fair value gap is, the next question we should be asking is, what criteria should we apply to fair value gaps to improve our odds of success? One of the highest quality fair value gaps form after a clear break of structure. Here's how that looks. Price is making higher highs and higher lows, indicating a bullish market structure. In strong bullish breakouts, price often doesn't move in a straight line, instead it tends to move in waves. Price pushes up impulsively, then pulls back to fill a fair value gap. After that, it pushes up again, breaks more structure, and creates another fair value gap. Then the process repeats. So over time, new fair value gaps are formed as price continues trending higher. The logic behind this is simple. Once structure has shifted and the overall market consensus turns bullish, buyers are no longer looking to sell rallies. Instead, they're waiting for pullbacks. Fair value gaps become areas where buyers are willing to step in because they offer a chance to enter in the direction of the trend rather than chasing price at higher levels. That's why fair value gaps formed after a break of structure tend to work better. They align with momentum, trend, and market bias. In this example, price was in a downtrend. We see lower highs and lower lows. Then price breaks above the previous swing high and closes above it. This is the first sign that momentum is shifting. After the break, price pushes higher and leaves a bullish fair value gap, which is quickly filled before moving higher and creating more fair value gaps along the way. It's important to note that a fair value gap doesn't always have to be revisited immediately. Price can continue moving higher first, break additional structure, and only later retrace back to fill the fair value gap below. When price eventually pulls back into the gap, traders wait instead of buying immediately. If price holds the gap and starts pushing up again, the fair value gap acts as a reaction zone. This is a fair value gap with context. To further improve the quality of fair value gap setups, many traders also look for Confluence instead of relying on the gap alone. One of the most common and effective forms of Confluence is support and resistance flip. In this chart, you can see that price previously struggled around this level, acting as resistance. Once price finally breaks above it, that same level later becomes support. After the breakout, price moves impulsively higher and forms fair value gap right on top of this former resistance zone. When price pulls back, it retraces into the fair value gap while also respecting the old resistance as new supports. This overlap is important. It gives traders two reasons to focus on the same area: the fair value gap showing imbalance and the support resistance flip showing structural acceptance. In trading, nothing guarantees a bounce. But when multiple tools point to the same level, it increases the quality of the setup and helps filter out weaker fair value gaps. Now let's look at another chart of gold. As you see, price breaks above a key resistance level. After the breakout, price pushes higher and creates a fair value gap. When price later pulls back, it returns to the area where resistance has flipped into supports, which also overlaps with the fair value gap. When price reacts from the zone, it shows that buyers are defending not just the fair value gap, but also the former resistance level. If this is starting to click, that's pretty much what the channel is for. If you want more breakdowns like this, feel free to subscribe. No hype, just clear trading explanations. Another important filter is where the fair value gap is located. This is a more advanced way of deciding which fair value gaps are worth paying attention to, so if this feels new, that's completely normal. In this bullish example, price breaks structure and moves strongly to the upside. As price expands higher, multiple fair value gaps are created along the way. To help filter them, many traders use the 50% level of the range, measured from the most recent swing low to the most recent swing high using the Fibonacci tool. You can pause this video to take a screenshot of my Fibonacci settings and apply the same setups on your own charts. Once this is marked, it becomes much easier to see which fair value gaps are forming in more favorable locations. In this chart, price reacts nicely from the first fair value gap higher up the range, causing an initial bounce. However, that bounce isn't enough to push price to a new high. Price then pulls back further and dips into the second fair value gap where we see another reaction. After that, price continues to retrace deeper and fills the third fair value gap near the lower part of the range. This behavior is important to understand. In bullish markets, price doesn't always reverse from the first fair value gap it touches. Often price needs to rebalance deeper before enough buyers step in. In this example, after price fills the deeper fair value gap, buyers step in more aggressively and price resumes its next impulsive leg higher, eventually making a higher high in the overall structure. This is why fair value gap location matters. All of these fair value gaps are valid, but the ones that form deeper in the range tend to offer less risk and stronger follow-through in bullish conditions. Now, before we wrap up, there's one important rule to keep in mind. A fair value gap is most effective when it is unmitigated, meaning price has not already traded back into the gap. Once price returns to fair value gap and fills it, that imbalance has already been addressed. At that point, the fair value gap has done its job. If you see that fair value gap has already been mitigated, you should not expect price to react again just because the box is still on your charts. This is a common mistake beginners make. Fair value gaps aren't signals, they're areas of interest, and the context around them is what matters. If this explanation helped you understand fair value gaps more clearly, this channel is focused on breaking down trading concepts exactly like this. Thanks for watching, and I'll see you in the next one.